Good morning, good afternoon, good evening. Back on the trend following trading club. Stocks, bonds, currencies, commodities, interest rates, crypto, short crypto. Yes, sirree. I am traveling and enjoying myself in New York City. You could probably tell because I was doing some ferocious twittering after during dinner, drinking good wine, and tweeting nonsense. But we're here today to discuss a lot of fun stuff, and we are recording. Yes, and I just went through my notes, and I came up with some things that I thought would be interesting to talk about. I like the Katie Kaminsky interview this week. Very good. Hashtag 1994. I thought that was quite amazing, where she basically says something like, these are interesting times, and we haven't seen this short bond trade or something that looks like a good short bond trade since 1994. And I think that is really a good point. I think I try to make that point every now and then, that we don't really care about history so much. As far as the performance of some of these markets, it doesn't really mean that much if certain markets and sectors haven't had good trends, haven't contributed much in a while. And I think that would just be so counterintuitive to most strategies that they would, how could you possibly include something or do something that hasn't worked? And so her year was 1994. I didn't confirm it. I just thought it was kind of funny, and I really enjoyed that. That's another thing too. I think I've mentioned before is that in my research of classic trend following, the only thing that I think I've found that improves the breakout is a systematic rule that might get you in a bit quicker if the recent performance of the market has been poor. So if it's been very choppy, no trends in a while, so maybe you can buy the 50-day breakout versus the 100-day breakout, something like that. You kind of speed it up a bit, slow it down a bit based upon how bad the market has been. Yeah, not how good. So you slow it down if the market's been really trendy. So, something like going long bonds or going short some of the commodities, that could take me a while because I'd have to wait for a longer term breakout. I don't think that sort of idea is necessarily required or materially incredibly better. It's just a little tweak that we uncovered a bit. And the only point I want to make is that it's the opposite of what you would think. Rich had a lot of good tweets this week. And darn it, I was even able to find something worthwhile from Rob Carver that I was really proud of this. Rob did a great job with Niels on the Top Traders Unplugged podcast, and I really enjoyed a couple of things he said. It was basically quoting Rich, so obviously it was good. Predicting, that was another hot topic. My friends like my take on that CTAs don't predict. I don't really even know why it even matters. If it was just a lot of semantics to me. I just thought that predicting carried with it some sort of presumption of probability. I think this will happen. But with CTAs, the win rate is so low, 40% max. And if your stop losses are tight and your losses are more frequent, it could be 10 or 20%. And can you imagine the opposite if I got up there and said, well, I predicted this bond market with my trend following system. I'm short. Look how much money we've made. Once again, I'm great at predicting. My trend following is great at predicting. They'd say, no way, you're not predicting. You've sold that breakout a dozen times. It hasn't worked. It certainly hasn't worked like this in 1994. So no, you can't claim that you're. So we lose either way. There's no way to win on this predicting thing. I don't really care about it. It makes no sense to care about it. I'm just trying to give people more of a transparent view of what we believe and how we do things. Good morning, Oleg. How's your technology today?
Hi, Jerry. Hi, everyone. Look, I think Oleg's might be having problems with his comms at the moment, but Yeah, Jerry, it was a good week this week. Lots of interesting discussions on Twitter. I was, interested that I obviously get blocked by Mike Harris, but I have a feeling that you probably had discussion with Mike regarding his views on prediction. Is that correct?
Hi to everyone. Yes, I periodically have problems with the connecting. I think maybe it's due to the problems with Twitter in Russia because it's totally blocked in Russia, and I use VPN services, and I'm very thankful for VPN services that it exists in the world, and I can take part in such important things for me. If not these VPN services, I think I would leave Russia because for me it's more important to these discussions is more important for me than to be in the country. So I'm very happy to be here. I didn't heard a part of what Jerry said, but he was talking about predictions, and I think that predictions in general is often a nonsense. So, for example, if we are predicting something, what will our neighbor say about us the day after tomorrow? It looks like nonsense. And why? And if we are talking in this that we will put money on this, and it depends on will we lose money or will we have money from a profit from this, what our neighbor will say about us or about another neighbor or another nonsense. It looks it's not looks serious. And why prediction is good in finance?
Yeah, Rich, that's exactly right. It was Mike and Woody. They were not happy with me trying to pretend that I don't forecast and predict. And I think I may have gotten in trouble as well by using those words interchangeably. So I could not please those men with my response. But I did post something else. I'm like sitting with my coffee, or later in the day, my glass of wine, and trying to come up with the perfect words to thwart them. But they're friends. Mike's good. He's pretty smart. So so then I came up with this example. Someone who is something's at all-time highs, and this fundamental discretionary or value person says, "Oh, overvalued. I'm going to get out. All-time highs. I'm calling it right now." 2 or 3 weeks later, it's down 30%. The trend follower is like, "Okay, I'm getting out now, and I'm calling this trade over." So whatever they want to say is fine, but it's quite a bit different in real life about how trend following approaches the markets, because we really don't even try to. And it's so much due to the size of the trade. If we get a trade right, if we predict it correctly, it means nothing because it's probably not going to go anywhere. And when you get the outlier right, you've seen that trade, you've done that trade a million times, you've sold that breakout, bought that breakout, and then the whole part of the trade was not even getting it right. The part was how far it went, and then you're a hero, or you're a genius, and you're doing really well. Like these trends, and so it's really just following that trend. And you sit back and you say, I keep doing the same job all the time, and the markets tell me when I'm going to look smart. And so I don't know about the predicting, but you didn't miss very much by being blocked.
I wanted to say that we have, like Neil said, and I appreciate this much, when we have extreme circumstances during the different crisis periods, especially in the beginning of the crisis periods, we have a plan to do. We do the same things. We not predict anything. We do the same things. And the guys who do predict based on predictions, what do they could predict maybe in March 2020, in crisis 2020, about what predictions we can talk in such situation. And we can lose a lot of money, really, really a lot of money during this situation in a few days. But if we have a plan, it will be much better.
Yeah, my views on the prediction is very much that I don't think it's actually a productive argument for trend followers to be talking about whether they predict or not. I think we could all agree that, we all trade with the expectation of positive expectancy over the very long term, and that's what our rules, that's what our back tests say. So I think that all trend followers could agree that if there was a spectrum where on one side of the spectrum there were predictive models, on the other side of the spectrum there were price following models, I think most trend followers would agree that we plot towards the price following spectrum as opposed to models that deliberately intends to capitalize on a particular repeating pattern or repeating condition in a market. Trend followers, we have no expectations about when these trends are going to occur. They're unpredictable in nature. They're unpredictable in magnitude. So the best we can do is apply a rules-based systematic process to capture these events when and if the market declares that they occur. So, it is a pretty counter. It's sort of like trying to just get a brownie point by saying that we're predicting by, accepting the fact that we all trade positive expectancy. But I think the essential point is that we don't intend on predicting on any single trade.
I want to say that I said this before once, that for example, let's imagine a competition with predictors competitions. On the one side, trend followers. I'm talking not about trading process or investing. I'm talking about predictions, pure predictions only. On the one side, we see trend followers, and on the other side, we see this global macro guys and so on and so forth. And I think that trend followers will win this competition and prediction different events. But we trend followers understand that it's not the best approach, even if we will. Trend followers know, I'm sure that trend followers know better how the market is organized and how the world is organized. It's my own opinion at least, but I'm sure in it. And so I think that trend followers will be winners here. And I have a lot of evidence of my thoughts. But we know that it's not the best approach, and the best approach is to follow your plan, to, like Jerry says, one entry, one exit, stop loss. It's the best approach, evidence-based approach. So we do this, and we not do predictions in our models, not because we can't do it, because it's not the best way.
Hello, Jerry. Hello, everyone.
Hello, Michael.
First, congratulations on your performance year to date. It's impressive.
Thank you. It's very surprising, honestly. And not only that, but there's been a certain rotation. Every time we start getting some trends reversed, we get bailed out by another set of trends. But these are kind of crazy markets. And as I've said before, I get a little unstable and a little bit nervous when I make money like this and so quickly. And the markets, I just know they can give back as fast as you're getting it. I'd much prefer nice, quiet, calm trends, a Fed that is doing a better job. But it is fun to be on the front lines and to suffer and to get rewarded for a pretty boring strategy sometimes.
Well, I think the answer is your performance is the result of skin in the game for many years and experience and good models. And now, as far as the prediction debate, I think this term prediction is an artificial image to attack. In finance, people use forecasting term instead. the prediction is used by, although it's used by prediction markets, the gamblers, but in finance, people prefer the term forecasting. As someone said before, if you are shooting for a positive expectation, this is a forecast of positive expectation. The debate is not productive. My personal opinion is that every time you enter a trade, you are forecasting implicitly or explicitly. If you are not forecasting explicitly as a discretionary trader, then this is an implicit forecast of a model. And but it doesn't matter. At the end of the day, what matters is the P&L. And I'm down like 2% year to date. Jerry's up like 27% or something. It's really impressive. And I'm a short-term trader with some longer-term momentum, cross-sectional, but I don't take too many short positions. So in the futures markets and commodities, those short positions, the left tails, they add to the gains when the trend is down. I won't talk anymore. I just want to hear your opinion, Jerry, because you are a legend in this area, about the roll yield from bonds and how the absence of this will affect the returns of CTAs going forward. And thanks for that. Thanks for the space.
Yeah, thank you, Michael, for being here. Yeah, I mean, I've read some of those papers that people put out a few years ago, CTAs, saying something about it'll be more difficult to make money on the short side of bonds than it was when we were long for all those years. The one thing, but we go ahead and do the trade anyways. I think if you do research, you'll see that whether something is in backwardation or contango, it will have an impact on the profit. Historically, it's still worth doing, even if that role is against your position. And then, of course, if you start slicing and dicing and fine-tuning too much, you start losing sample size. And then you will miss a big trend where the roll yield, even though it's against the trade, the market will go so far as to make that kind of inconsequential. I think the one thing that I didn't understand that was continuing to be left out of the discussion is the fact that the CTAs size the position based upon ATR. So if we get a moment where the volatility, just a couple of weeks of low volatility before the market breaks out, let's say, then we could have this huge position on. And then if it doesn't happen and we have the roll year in our favor, and the volatility is very large, and so we have a smaller position, that would harm the trade. So in all the papers that I saw, I never really saw anyone take into consideration that how things could change by the size of the position, which is for the CTA community is dictated by the average true range and the volatility of the past couple of weeks. So, and then of course the other parts of the papers were that, well, even if CTAs don't do as well being short the bonds as they did being long the bonds, historically other markets in those periods, commodities or stocks or maybe even currencies, they have done well. So it can be a good environment, even if we're not making as much being short. And of course, I short some ETF fixed income markets, TIPS, muni bonds, mortgage backs, junk, preferred, convertible. So I short those in my cash, in my stock account. So what does that mean for those? Are they going to do better than the futures? I don't know. But I think as a CTA, you run across a lot of situations where historically or even mathematically, it doesn't look like this trade is going to do very well. And we do them anyways out of this idea of being incredibly consistent and disciplined and doing all the trades and being super surprised. I had a filter on my short crude trade in 2020 because it did, on my analysis, that short crude trade had limited downside. So you know what happened there. So it's really dangerous to have filters and to think too much as a trend follower.
Jerry, now that you mention ETFs, some of those ETFs, like the USO, they have a poor tracking error. Actually, they don't track the underlying at all. So those are not good instruments for trend following. Do you analyze those before you enter your positions? I mean, some of those, like for instance the DBC, they track the CRB well, but some are horrible, like the USO thing. What do you think?
Well, I would only use an ETF if a future wasn't available. So if there was a future, so there's futures for almost all the commodities, especially commodities that also have an ETF. But in my understanding is I don't think they're now. I think on the short side that USO had trouble, but I hear a lot of people complaining about a futures-based ETF not tracking the cash market, and there being some sort of difference between comparing the movement in a commodity based upon the cash market as it relates to a ETF. Well, the ETF just contains futures, so it's the same experience that we get in trading futures, at least on the long side. I know there were problems, I think, on the short side of that crude ETF, but it's really just the problem that you have to pay in a futures contract. You have to pay storage and cost of carry and things like that in these contango markets. So it's normal. It's what we all have to face, and it doesn't seem to be a problem trading futures versus the cash. We can't trade cash anyway, so we love to leverage it up and use the futures markets. There's nothing better.
I think with your performance, I looked at your record the other day, and I calculated a 10% annualized return since 1988. You should have like 10 billion or maybe 50 billion AUM by now. What is happening in this market? You are not after, you want to keep size low? Sorry, I'm asking this question. Maybe it's too personal or business model specific.
No, it's fine. I have a great life now with my small company and it's really beneficial to, in some respects, to you don't want to be too small and then you don't want to be too large, and it's really fun being able to trade in some of the smaller commodity markets. That's been fun and profitable. So I don't know. I think what happened with the CTA business was it became a business, and it was so important to manage large sums and get clients from institutions that you had to look like their institution. And I think we just didn't make those type of investments to like some of the larger organizations with large head counts. So we didn't look institutional quality, institutional worthy, and we didn't speak the institutional language. It's really, I'm reminded all the time, because I do speak to people who allocate and who have lots of experience. And I can just tell you, I'll tell you a showstopper right now. I'll tell you something where people, if you bring up a certain topic, it'll be the end of the conversation, and that's volatility management. Volatility management is a given. It's a given. And when I get in there and start talking about letting profits run regardless of the level of volatility, and some of these markets, I mean, the volatility is the position I have on now. It was originally very small. If I took a full loss, I would lose 15 or 20 basis points. Now these trades, the volatility is just gigantic. It's so many of them. I keep track of my risk units. And let's just say originally when I put the trades on, I have about 4 units of risk. But now, if you look at today's volatility, my units of risk on those positions is 50 to 100% higher. So this makes people very nervous. It's a given in the industry, and people do not take kindly on listening to me talk about how volatility management is not the way to do it. It's not the way to maximize your CAGR, and it's really an attack on their worldview of investing. So I have too many things going against me, and as you know, we're all humans, and having good performance is sometimes not enough. And then these days, this year in particular, the past couple of years, I'm more proud of those years. They were plus 20% in 20 and 21 because there weren't a lot of people doing that in those years. But this year, everyone is doing well. And so you can look around and find managers and CTAs that are more fit that particular style of vol management and not having an American accent. Those tend to be two things that I think are kind of a requirement these days to maximize your AUM.
It's very interesting, Jerry. That there is a huge difference between this attraction towards AUM and then the attraction towards performance. And I'd see this even in the the trend following indexes. The two popular trend following indexes are the SG Trend Index and the B Top 50. Even though the B Top 50 is not specifically trend, it's top CTAs. But both of those indexes focus on the largest in terms of AUM as though that is the best performance measure. But it's interesting when then we do this. Niels and I compile this TTU trend following index of all of those trend following funds which simply have a long-term validated track record as opposed to the size of their AUM. And you see how the entire index significantly outperforms both of the alternative trend following indexes. And this is just a case of people being attracted to marketing, people being attracted to size, people not really caring about the underlying performance.
And I think here that not only underlying performance, as Jerry said and Neil said, and other traders said, and investor, that recent performance is important to the people, and it's a problem that people look at recent performance. And even Neil said once that when investors decide to invest in the fund, they look at decades of track record. And when they decide to stop investing in the fund, to take the money from the fund, it's enough to have 6 months of not good performance. And of course, it's a very, very bad situation for the investors, first of all, not for traders, I think. First of all, it's not consistency. It's, as I wrote once on Twitter, that investors want consistency. They want consistent returns every month, but they are maybe most inconsistent guys in the world. So they see few months, maybe, as I can see this, my personal opinion, that they see few months of good performance and they invest and they see 1 month of bad performance, a drawdown, and they stop to invest, and this inconsistency can destroy their accounts.
So let's just do the opposite, though. Let's let me evaluate traders, and if a trader came to me and said, well, here's my record this year, especially, or even over time, and I started asking them questions on how they trade, and they'd said, well, I don't go short. I do a lot of vol management. I don't diversify that much. I don't think diversification is that important. I'd say no. They'd say, well, look at my track record. I'm like, no, you violate too many of my worldview points. It's all about trends. It's not about vol management. It's all about longs and shorts and maximum diversification. I don't care what your track record is, and I think that, that's the way I would act as well. I don't think it's apples to apples because, obviously I can make a pretty good case of why, more classic and more diversification is a better approach. But still, that's the biases we all have towards other strategies, or at least that's the ones that I would have. If I was involved in the TTU Rich and Neil's project, you know me, I would not just take all of those traders and say, hey, if we just take them all, this is going to be great performance. And I no doubt, right? But I would have to dig deeper. Well, wait a second. How does this guy do it? How does this girl do it? Let's kick them out.
Then we'd have the TTU JP Classic Trend Following Index.
It would just end up being Richard and me and Moritz. So that would be good too. But inevitably, I think, this is another rub on backtesting and analyzing even track records, is that if we did something wrong in our trading and we had a rule or an idea, which I have done this before, that was not healthy, I've had a couple of unhealthy ideas, rules, methods, and processes. And then all of a sudden, you just get skunked and you lose a bunch of money and you understand, man, that was a real weakness. And someone would say, did you have to even see it happen? Couldn't you figure this out before it happened? I would say, yes, you're right. I should have figured it out before it happened. I didn't need to see a sample size of 2009 or 10 or 2007 was tough for me as well to realize that I had this mistake. And so it's not a good excuse to say, well, the track record, the 5-year record was great, and this weakness of not letting profits run, for instance, it really didn't show up. Hey, look, this is a problem, and this little bomb is embedded in your performance, and it's going to go off and blow up one of these days. And so, as much as I appreciate track records, a lot of bad ideas can kind of go, I lost the word I was going to use, kind of be sleeping and not show their ugly side for long periods of time.
I want to say that, and I think most of us know this, that when we see smooth returns, and it's a very big challenge for investors, especially for the unsophisticated investors, that young investors, that they like smooth returns. And we know that smooth returns, Niels said that a lot of times, Jerry said that a lot of times, that smooth returns can be very dangerous. In fact, I can say that we can see here maybe a compound drawdown effect. We can't see a drawdown on the chart, on the track record, but it exists. And sooner or later, we will see not 10 or 15% drawdown. We will see maybe 70% drawdown, and maybe more than that. And this smoother returns, because when we look at the chart, every chart, don't look, my thoughts, don't look smooth. It doesn't look smooth every chart. I don't think so. And I think our way of trading, if we are capturing the trends, especially, must be looked like a chart. It must be close to the chart, must be similar to a chart, and in this way we will handle the pressure of drawdown, and we will win and take these outliers. We will be winners here, and it's not a smoother way of doing the things, but it's the best way.
Okay, maybe I will talk about this. Since Jerry mentioned backtesting, sometimes I meet people and along the years, and they say, "Oh, we backtest every day, constantly, to find a good idea." And I tell them, the more you backtest, the higher the risk you will come up with a random strategy. And I have an article like this in my website about you only backtest when you have a really good idea, because each time you backtest, you are using data. And this is the definition of data mining bias and selection bias. So I have been using the same strategies for the past, since 2017. I backtested a few new ones, very few, like 2 or 3. And when I see someone, I mean, in those firms, they have these young people, and they do backtests all day with typical prices or alternative data, and they use them, reuse them until they find something like Oleg said that has a very smooth equity. I mean, this is the definition of hindsight. This won't work. It may work for 1 or 2 years. And when the market conditions change, you get a huge drawdown. I mean, it's huge. Now, this is where the Sharpe ratio is very important, okay? Because the drawdown duration is proportional to 1 divided by Sharpe to the power of 2. And the depth of the drawdown is proportional to the inverse of the Sharpe ratio. Okay, so to find a good Sharpe ratio without frequent backtesting is very hard. And Jerry knows Linda Braga of the Blue Trend Fund, probably. And she said once, I think she's doing very well this year too. She said once that we only backtest when we have a very good idea. We don't backtest. I mean, the more someone is backtest, the higher the chances they will find a random model. And if this is done continuously, the probability becomes 1. And this will be a devastating loss. And I will end this here because I have to prepare a report. And thank you, Jerry. Excellent performance this year. I was following your fund since 10 years ago. And actually, once I did some analysis to find if your performance was due to chance. And I found out that it was not only your fund, but some others, not only your performance. And I found out that it was not due to chance. And goodbye, everyone.
Yeah, thanks, Michael. Yeah, I mean, I've talked about my research process. It's pretty, I mean, it's not much to it, but I think the reason I get away with my research process is because trend following is doesn't work as well with optimization as it does with not optimizing. So I basically look at the markets and charts and come away from just my eyeballs approximating what parameters might work. So I say to myself, I think the 100-day breakout works. I like the 100-day breakout. No evidence whatsoever. But I just say that to myself. I flip through all the charts. I look at the big outlier trends, and I say, okay, yeah, and most of those big outlier trends, I didn't get out too quickly. See, that doesn't sound very scientific, does it? And so then I say, okay, researcher, how does the 100-day back test, does that work? Does it work? Does it make money? Does it make enough money? And they say, yeah, it does. Okay, we're done. System one, right there, done. That's it. I don't even optimize. I don't even care what, if that's not the best breakout to use. It looked good to me. I confirmed that it did not lose money. So this is like not acceptable to most really smart people who run large CTA firms. They're not going to make more money than I am. But the Sharp is going to be better, and because they're going to add features that focus on Sharp, and I don't focus on Sharp open trade volatility. I really take it seriously when someone says, let your profits run. What else? You mean let them run until something? Let them run unless something? No, let them run. Oh, really? Yeah. Well, when I do my back test and my optimization, I find better ways than just letting them run. Okay, I disagree. You've got some hidden problems there that you're not going to like one of these days, and you're not going to make as much money as I am, and you're miscalculating the risk of loss of capital. So things we just keep repeating every week. But yeah, so I think there's ways of making sure your research process is much safer and more robust, especially if it relates to classic trend following, one entry, one exit, and a stop loss.
Totally agree, Jerry. We've got to be very careful about which edge we're attacking first, because that totally changes the process we use to extract that edge. So with our classic trend following models, we are specifically targeting the edge that resides in the tail regions of the distribution of market returns. But with alternative convergent models, they're specifically targeting the guts of the distribution around the distribution's tendency towards an equilibrium. So the two different edges that are extracted there are they're complete opposite ends of the spectrum. The mean reverter needs a high trade win. They need to capitalize on a particular market regime. The people seeking the edge in tail regions, they're not targeting regimes as such, they're targeting the transitions between regimes. So a totally different model, a totally different process applies. Therefore, the backtesting is a totally different process itself. So with a mean reverting model, which is trying to target a particular repeating pattern that's existing in a market regime, they want a high trade sample size because that validates their premise. It validates the nature of the predictable pattern they're trying to exploit. But with trend following per return stream, because we're targeting transitions that are unpredictable in nature, both in terms of when and in terms of magnitude, we need a small trade frequency per return stream, but we therefore need extensive diversification to lift our trade frequency. And also our process enforces that we're not looking for the particular characters of each individual market we're trading. We're looking at these outlier, or the ability for these outliers to exist in these liquid markets. And that tends to be a market-wide phenomenon as opposed to a specific characteristic attributed to the market. Therefore, our process is totally different to what alternative models are. Therefore, in everything, that means that the ratios we use, Sharp ratio, not appropriate for trend following. It's only appropriate for mean reverting models, convergent models, we require risk metrics that accept volatility in them, such as the MAR ratio, or things such as alternative ratios that are path dependent, as opposed to being things like Sharpe or Sortino. So it really is. You've really got to understand the edge that you're attacking, and that therefore totally changes almost everything you do about how you trade these markets.
So, like, if I need to summarize, like, get to the nit of it, to me, it sounds like, obviously, with conversion models, you're looking for equilibrium. So backtesting most likely will be more important, because you're actually trying to box it in, right? Um, the actual channel, the equilibrium. Whereas with trend following, of course, you want loser pants. So if you do too much backtesting, you will actually box your strategy in, and that loser pants will actually become tighter, and you might get into the process of eliminating the outliers. So because we're looking for that divergency, we don't want to box it in too much, and therefore backtesting is something that need to be treated differently, whereas compared to with conversion models.
That's exactly right, Jay. So for mean reverting environments, or for regime dependent market, or regime markets in a particular regime, or predictable stable condition, that's where these predictive models, we've discussed about predictive models, non-predictive models, but that's where predictive models fly, because they're exploiting that characteristic of that regime. Therefore, and this is this tendency around an equilibrium. So you need an overfit model when you're trading convergent models. The overfit means that you specifically want to respond to the nature of that market, the repeating nature of that rhythm, the repeating nature of that oscillation. That means that you need more complex models, more overfit models, to actually capture that nature of that market. But trend following, which is targeting transitions between regimes, which are divergent in character, they are diverging away from equilibrium. That's high volatility regimes, very unpredictable regimes. Uncertainty characterizes it. We need loose pants and very simple models. We need underfit models for any particular market regime. Therefore, our models are applicable across all markets, as opposed to being specific to an individual market and its character. That's why our models are much more generic, much more simple in nature.
And for me, I think stability and consistency, it's the same, it's equals than adaptivity. I have said that before, and robustness. And I have, so we must understand, and Niels said that in one of the episodes, that we must understand what the stability is, what the consistency is. And really consistency, as I remember, he said that it's following our rules and have good, consistent returns because of this. And so I did, in previous years, I did a lot of backtest of different strategies, different directions, and I had maybe 5 or 6 years ago, 2017, 5 years ago, I did a backtests of mean reversion system, and I have found, it's my own personal opinion, but I have found that this system are not robust enough, for me at least. So as I have seen that, we can see a drawdown in this, and after that we can see maybe a little profit and even a bigger drawdown. And I'm sure that trend following systems, even if it's not a classical trend following, but trend following idea, like Jerry said, improves a lot of mistakes, a lot of bad ideas. Only the idea to follow the price improves a lot of bad ideas. So I totally agree with this.
Look, to be fair to convergent models, there are particular regimes where convergent models certainly do outperform divergent models, such as trend following. And, we experience that between 2010 up to 2019. There was a couple of years in there, 2014, etc., which were stunning for trend followers, but the majority of that regime, that low volatility, stable regime, was a bad time for trend followers. However, so convergent models do make money during those particular regimes. Trend following or divergent models make money during these more sort of transitioning environment sort of regimes. However, where the Achilles heel of convergent models comes in is in when the regime changes, and this is no one ever considers that. So convergent models are all the sort of favorite model to use while things are working well. You get these magnificent straight equity curves flying up to the sky. Everyone thinks it's doing well. Typical classic LTCM, sort of that beautiful straight line equity curve. However, when that regime changes, it's unlike trend following models, because we don't turn our models off. We never have to turn our models off because our models are sort of regime independent. They can survive over lots of different hostile market regimes, and they flourish during certain transition periods. But they never have to be turned off. But the Achilles heel of a convergent model is that they do have to be turned off when that regime changes. And that's where the negative skew comes in with these convergent models, because they inevitably get turned off when they're entering their maximum drawdown. People can't take the heat anymore, and they say this model isn't working anymore, and they turn it off. So as soon as they turn it off, this is a problem. They introduce negative skew into their portfolio returns. And this is where they sacrifice their CAGR over the long term because of the drag associated with that negative skew that's accompanied with that decision, that timing decision when to turn it off. And if they don't turn it off, they can go to risk of ruin. So we never get into that situation because we always cut our losses short. So we can get bad regimes where we get stagnating equity curves, or we can get building drawdowns, but not accelerating drawdowns, because ultimately we cut losses short, so the risk is released from our portfolios. But the convergent model, their drawdowns are fast, and they can become terminal because they don't have those risk mitigation mechanisms in there that a convergent model does.
I think that very important here is such thing as investment horizon. And if we are talking about 3, 4, 5 years, and I think it will be more preferable, and it's more benefits, and performance will be more good in diversion models. And not all people understand this, and of course I accept this. And for example, I know one girl, she invests in crypto fund with a 30% a month profit, and I said that it's totally bad idea because it's very risky. And she said, why? I invested money and I have my money back in 3 or 4 months, and then I have a pure profit. But in fact, it isn't so. It only looks so because we don't know when such fund will blow up, and it may be tomorrow morning. It may be in a year. It may be in 5 years. Will be a big drawdown. Will be problems with this risky fund. And if we do this, maybe for 2 or 3, for example, we invest in a fund which is risky, and we have our money back, we have even profit, we stop investing in this fund and invest in another fund. Sooner or later, we will be in 3, 4 years, maybe, or maybe even sooner. We will be in a not very good situation with our money. We will lose our money. So, and trend following, classical trend following, like Niels said a lot of times, that we have a lot of evidence. We can see funds, that trend following funds, which works for decades, for 50 plus years. And I don't know any Convergent traders who have such a track records. Or maybe global macro guys, maybe only few. And in fact, if somebody will show me even some macro guys that have such track records, I don't understand totally what are they doing. So I don't understand how can I repeat this. And so it's such strategy are not acceptable for me personally. And I understand, like I say always, I understand the logic that lies behind the trend following systems. That it's we can see here the laws of nature, a laws of behavior, a laws of market. It's all the whole one thing for me here, and so I don't see any strategy that have so much benefits like classical trend following strategies.
Hi, Niels. What's going on?
Yeah, just tuning in. Always enjoying the conversation. So yeah, just picking up on the topics. Other than that, nothing spectacular. Other than it's good
It seems he's
not
still
to be a
connecting.
fundamental trader in these days with all the uncertainty and all the action. I think it must be nice to wake up every day and know exactly what to do with your investments.
Yes, and go to bed at night being as diversified as, or more diversified than most of the other investors, with hopefully some rules and some stop losses to allow you to sleep really well.
I was going to mention one thing. To me, it seems like trend following or the strategy behind it, the divergent models, is a more relaxed strategy compared to the convergent
Hi
models.
guys, can you hear me?
Just because of the key points behind it, cutting your losses short. So you have those small losses that can build over time. Obviously, it's not pleasant, but it's slow. Whereas with convergent models, it can be a gain, long time of gain, and then you can have one big drawdown and it wipes everything out. So to me, the difference between those is quite interesting. But I like the slow one. I like the slow death actually, um, in that sense. But yeah, it's quite interesting. I always say uh, there are people that have joined, strategies such as those crypto funds, and they've gained and they got out at the right time. Obviously, that's not for everyone. So those type of funds are quite risky. I'm not saying that I believe nobody can obviously make money out of it or the profits, but it really then becomes more of a chance, or how do I say, having good timing behind your back to ensure that you don't lose everything. And obviously, we most of the people here would want to have a more sure, more robust strategy, and that's where you want to stay away from those.
I was going to add, and some of you know, I come from the grain sector originally, and adding some convexity to physical commodities with existing contracts can be a force multiplier, and that's the only time I use it is in the grain marketing and delivery around existing contract positions. But from an outright, um, you know, family fund and actual use of compounding intergenerational wealth, trend following momentum is the way to go, and the statistics bear that out. And then if you have some physical asset with which you have existing contracts and such, you can create risk-free trades. You can't do it all the time. That's the issue, and that's the rub too. And if you don't know what you're doing and you haven't had a chance to understudy somebody, you can get burned. So just, it doesn't matter whether you're in futures, or you're in stocks, or you're in physical hard grain assets like Kansas City wheat or soybeans or corn. if you don't know what you're doing and you're playing with convexity, you can get burned. That's all we'll say. Thank you.
And I want to say that today I mentioned that Niels said very important thing for me personally, that we trend followers always have a plan. And when we can see a lot of extreme events, we have a plan. And when we don't see any extreme events, we have the same plan. And these macro guys, different other guys who have different plans, they can be in a big trouble when they see extreme events.
I mean, in terms of being a trend follower, I just wanted to mention, I am a quant trader. So what I do is I code, and I code my own backtests. And I just wanted to share that, there's a lot of freedom and independence to be able to actually code your own backtests, your own strategies, and then test, after testing those ideas, to be able to trade them. Because among us, of course, there are a few fund managers, so they hire developers. But for the majority of the traders, they who wanted to trade as a trend follower, I think we are talking about the let's take the 100-day breakout, let's have a very large ATR stop losses, but there's a journey to be able to get there. And how are you going to trade this stuff, the stuff that we are talking about? And my answer to those is the journey is to be able to learn coding. So you code your ideas and then trade those ideas. So I think we are not talking about that, the initial part of the journey that requires us to get there. And I find that it is hugely important because these are very expensive ideas, all right? So you wouldn't want to be really trading 100 days breakouts, because if you put, a rate of change filter, a 100-day breakout or a 123-day breakout, this is a 6-month breakout, might even work better. But to be able to see the impact of, what works, so you need to test it. So you need to understand the concepts, and the only way that you can do it is to be able to test it. So I think we've been talking about these things, and as a new trader, I've been learning how to develop a code over the years, and I've managed it. At the end, it has been a huge struggle on a personal level to be able to learn coding, but I can tell you that it's worth the journey. And if there are new traders among us, not Jerry or not Brian, not Neil, and possibly not Oleg, but new traders, I think my recommendation would be learn to develop a little bit of code and backtest your ideas, and then you can join into this conversation. Because without having that sort of a background, either you have a development team who's working for you, a guy or two actually, whom you are paying $150 for an hour, or how are you going to get to this point? So I just wanted to mention that there is a lot of work to be able to even try to trade these ideas, and I wouldn't recommend anyone else just to jump in and trade a 100-day breakout because they've heard it somewhere else. And just trading those models actually is not different than stock picking, because if you're not actually know what you're doing, it's not different than someone else is saying that Apple stock is going to shoot, why don't you trade the Apple stock? So it's very important that there is some homework that needs to be done for the newbie, the new trader who started this journey. I just wanted to mention that. Thank you, guys.
I think you mentioned a good point, but I would phrase it a little bit differently in a sense, because actually I think it's not just relating to trading and investment, right? It's related to everything we do in life. Is that we need to be prepared for whatever we want to do. We need to have a plan, because otherwise, if we fail to prepare, we prepare to fail. And I think that's just much more universal than just systematic trading, frankly. So I think your points are valid, and the beauty of having a plan or having rules is, as you say, that you can test them. You get an idea of whether it's a good plan or whether it's a bad plan, and I think that's pretty valuable on a very basic level.
Yeah, look, Mike Harris raised a very good point about backtesting. Look, it is essential for all of us. All of us here mostly are systematic traders, so we all do our coding. We all engage in rigorous backtests. However, as soon as you undertake a backtest, you are contaminating that data within sample bias, and so the only way you can make an assessment of your future performance is to, once you've undertaken your backtest and refined your models, the only way you can get a more reliable estimate of the performance of that model is by testing it on unseen data. Because as soon as you undertake that backtest, you will be overfitting that result.
Yeah, I like that idea. I remember, so when I started, I was told what worked. You know, these parameters, these type of ideas, this is what works. And so it was fun, but it's way more intellectually rewarding to do that research yourself. And then as soon as I went out and started Chesapeake, that's like the year that TradeStation came out. Well, it was originally called System Writer, and it's perfectly fine. And I used to do research with my friends. We all had System Writer, which turned into TradeStation, and it was great. Now, the only thing it didn't do basically was combine the results, like the daily equity of corn, the daily equity curve of soybeans, and you had to sort of integrate Excel into that. But you know, looking at the trade stats and getting that, in, you know, building your systems, that was really fun. And I agree totally that that's the thing to do. That's the way to go about it. And I was talking to some young men in their 20s who were visiting America from the Dominican Republic to learn about trading, and I did a Zoom call with them this week, and that's exactly what I told them. I mean, look, you're young, you're in this decade, in this century of computers and coding. You should be able to figure this out. So I think that's exactly, we should own these systems and really fall in love with them. And the benefit of doing your own research is really important. I really like that point.
Jerry, I was working and listened to System Writer Plus, and I bought maybe the first 2 copies of the Cruz Brothers. You remember the Cruz Brothers?
I do.
And that was an amazing product, of course, and but some people didn't understand what was good for. And I want to mention something here. First of all, I agree with everything Richard said before that. Backtesting will tell you only what worked in the past. It will never tell you what works in the future. And this is very important. It's a very fine point, subtle point. People don't understand. Every backtest is conditioned on past data, and you use backtesting to reject strategies at the expense of what is called a type 2 error. You may reject also some good ideas that didn't work in the past, that may work in the future well. And this is very interesting also and very challenging. But backtesting will never tell you, even if you do out of sample testing, they are all biased. Even if you do real trading for a year, there may be still bias in the due to persisting conditions from overfitting. So backtesting, for me, based on my experience, having used System Writer Plus since it came out. And before that, I was doing my own backtesting out of college in Pascal. Is a tool to tell you what doesn't work, not what will work in the future. This is very important. People, I don't think many people understand this. The experts like Jay or Richard, and Oleg, and who have been in the business for a long time, they do. But most of the young people, especially, they don't understand this. It's very crucial to understand this. Something worked in the past, fine. It may not work in the future.
Yeah, I couldn't agree more. And basically, I think one of the problems is there's too many rules, and somehow we got into a situation where rules became the bottom line, and robust rules were not the bottom line. So I've often said that I don't think it's possible to take less from the back test than I do. I want to take as little as possible. And basically, here's a pretty good place to buy, here's a pretty good place to sell. And the rest is more philosophy. Philosophically, I'm going to make money if we have outlier trades that are bigger than the losses. Diversification is always correct, always right, mostly, to have even weightings in the sectors and try to trade most of the markets or all the markets the same size. And so I'm really big on philosophical ways of looking at the markets and not trying to depend upon the trades in the back test. But all we are saying is that these particular methods of getting in and out of trends and these particular parameters, that at least they've worked in the back test. And then that's why I'm a big proponent of trusting the systems even less by trading small, being careful with your risk, your leverage, and then not relying upon the system in the strategy to make a comeback, but really overlaying the system with that one rule that if you get into a situation where it looks like all hell's breaking loose, and that's not a very good technical term, I know, but I think it's fine to have a rule where you just sort of say, hey, I'm going to cry uncle with a 20% drawdown or 10% drawdown, and then I'm going to reduce my positions and do all I can to. I think that's something that every type of strategy needs. You just cannot rely upon the back test that says, well, that is unnecessary, because as soon as I back test this cutback rule, it has a tendency to pick the lows in my equity curve. And that's definitely been my experience, that almost every single time I said, okay, I'm kind of, this drawdown is getting out of control, I'm going to reduce my positions by 20% or 50% or whatever the rule is. That has a tendency to call the low in my equity curve. But it only takes one screw up. We see this all the time. Famous hedge funds down 50%, crypto markets crashing. So whatever you do, we love our system. We love how they've done for us. We're happy with the back test. We've been conservative with the leverage and with our assumptions in the back test. But then our bottom line is we have to stay in the game. No set of rules is worth relying on if they could put us in danger.
I think that for me, very important to understand that a strategy which is backtested by me is a pure trend following strategy, and it's not going against the core principles of me as a trend follower trader and classical trend follower, because I was talking I said before that one guy a few years ago from London firm sent me as a gift a system, not trend following system of a firm, and he said that it's a gift for me and it's a secret, and that I must not share with anybody with this, and he can have a problem. And I said, okay, but if even I wanted to share, and I have said that before, I wanted to share this system, I can't do it because I don't remember the system. And for when I was testing this, it was 4 years ago, and I test 1 year or 2 year, and it was looking significant good. And I thought it's too smooth, too good. I think it will be a hidden problem here. And when I began to test a 3rd year, I saw that it has a large drawdown and it's risky, and I don't like this, and I don't understand how it works actually.
A very handy gauge that I use. I use the backtest as a means to test for robustness. So I'm seeking to break my models with my backtest. So what I'll do is that I will develop a backtest for a particular market, and then I'll normalize 40 or 50 alternative markets and then trade that model on all of those different markets to see if I can break it. In other words, by normalizing different markets, I'm getting alternate possible histories, so that, when you trade a diversified portfolio of, say, up to, Jerry's up to 200 markets or whatever, they are all viable market data streams that can be normalized to test the validity of that model. And they give you a way to navigate an uncertain future by at least suggesting that from what the past has presented across 200 different possible alternate histories, this model stacks up in that it obeys the golden rules of trend following. It's asymmetrical in nature, it cuts losses short, lets profits run. It doesn't mean that you get selective over which markets you trade because of their performance, because each of those possible markets represents a possible future history. So you've got to be steadfast and trade all of those markets into the future, as opposed to cherry picking the better markets that perform better with those models, because that's not how trend following works. That's how convergent models work, because you are seeking to exploit a regime, a historical regime, a predictable pattern. That's where backtesting is a totally different premise. You're actually seeking to, with pattern recognition or whatever, exploit this repeating phenomenon. But in trend following, these trends, they're not repeating phenomenon. They can occur anywhere. And so what you do need to do is you want to eliminate the impact of noise, and you want to eliminate the impact of mean reversion in market regimes. And you do that through the backtest, which defines how loose pants you need to be with your stop, your trailing stop. And of course, you've got no profit target because you're using a trailing mechanism to exit your trade. So you're keeping your models very simple, very loose pants, and very robust.
Hey,
By the way,
Richard, I want to go through a scenario here quickly, and I want you to comment on it. And I think I can remember all my points. Okay, so I look at the charts and I look at these breakouts and I say to myself, okay, I think I only looked at the big outliers, 50 trades or 100 trades, okay, over many decades. And I say, okay, this loose pants breakout, that should work. And then I do the back test, and the back test says, yeah, it works. Okay, so I do that, and I start my career, and I'm making money, and then I hit a period where, so my sample size is high, or it's high enough, and I feel really good about it, and that is to me defining my robustness. What is the sample size? And then I hit this period, after 2009, where it doesn't work as well. And people say, well, why are you still doing it? Well, I've identified that it's not working well because it doesn't have these outliers. I haven't had the same amount of outliers. And I think I'm just going to think in the future that I actually might see more outliers. 2020 comes around, 2021 comes around, 2022. Aha, you're right. You finally did start seeing those outliers. But then we really didn't have any evidence during those dark years, the dark period of 10 years where we were not having seen as many outliers. So what could we possibly confirm by that recent data since the trends weren't working? And I left out one thing. I wanted to say that when I came up with this idea to only look at the parameters that worked well with the breakouts that I was trying to eyeball, of course someone could say you're completely ignoring the other 95% of the trades. So you may have come up with a good breakout entry-exit system for these outliers, but you'll have to wait for the backtest results to come back to see how these parameters handled the other 95% of the trades that were small winners and losers. Well, it comes back and it says it's irrelevant. The only thing that matters is handling those large trends the best way possible, and multiple breakout systems. That's a great way of doing it. But it seems to me, since we're so we do have a large sample size, but it's totally dictated by the outliers, how we handle them, and do we have enough of them. Now we're having an overabundance of outliers. Something special. So to me, it's really like looking at that long-term backtest is all we really have. And so there's no way to confirm the robustness or the validity of our systems with any sort of recent data, this data or the data before 2020, which pretty much sucked compared to the prior data. So I don't even know if there's a question in there, but what do you think about all that?
Yeah, look, what I'd say is this. I'd say our problem is not in identifying outliers. That's a given. And we can eyeball charts to identify, long-term historical charts and say, these are the outliers we want to catch. So that's this 10% of trades, these outliers. That 90% or that 95% of trades is something we want to avoid. And that is something we want our backtest to exclude. Now, that 95% of noise and mean reversion does change over time. So, back in the 80s through to the 90s, where you could trade those short-term trend following models, that was because noise and mean reversion was less in those regimes. But given the complexity of markets and the increased participation and all of these different factors, post-2000, the influence of noise and mean reversion became more and more profound. Now, what that did was that started eating away at the benefits of those outliers we're catching. So that meant that you needed to step out in time frame into your long-term model. So what I'd be saying is that we can't rest on our laurels. When we do a backtest, we really should be doing it across our entire portfolio every year and including one more additional year each time we do it of historical data, because that contains information of the trades we want to avoid as opposed to participate in. So noise and mean reversion is an ugly element. There's two sides to our performance. One is the success from capturing these outliers, and the other is the losses and the whipsaws we incur with the noise and mean reversion. We can do something about that through, the backtesting process to ensure we're trying to exclude that impact as much as possible.
For me, any sort of additional clarification and information from those bad 10 years would have been misinformation if I would have changed my systems at all. So I never changed them, thankfully. I totally ignore that data where there wasn't enough. Well, I mean, I didn't try to find a method that would work good in that period of time where there weren't enough outliers. So, but I do agree that that's the way to do it. You add another year, just keep adding another year, but use the whole data set and not recent performance or recent. Don't
Yeah,
overweight
exactly.
recent. Yeah, don't overweight recent trades.
Markets do adapt over time. There's no question about that. But the outliers still persist. They're still as unpredictable as ever. Their magnitude is still great, but the nature of the market does change over time, and we've got to make sure that we do introduce that. Like, interestingly, the question I'd ask you, Jerry, is what actually made you go to more longer term models? Was that just a decision at one point in time, or was it because you were experiencing something in the back of your mind that saying, hey, these trends are changing? What was the actual influence that made you step out to the longer term timeframes, and when did that occur?
So for me, it occurred in the late 90s. And I think I was definitely living through the trades. All these trades, I was living with them on a daily basis. And I just started noticing that, we got out of, I think, the wheat short, some short wheat trades. I would just focus on that chart, and I would just see how it kept going lower and lower for a year or two, and we would keep getting out and then sell the lows again later. And I started playing around with the charts and increasing the look back period, and going through the markets and looking at maybe even weekly charts. And I was shocked at these monster trends that were popping out. If you look at weekly charts with the weekly breakouts. So, a 20 week versus 100 days. And you put that channel on there and you're like, holy smokes, that's easy money. And I'm participating in these trends. My whole focus on what is a big trend, quote unquote. I used to think it's a different definition now. It's multi-year, not what I learned with the turtles, multi-week. And it's easy. And then here's the killer. We've talked about this before. Here's the kicker. The longer term systems, whatever reason I decided to go to them, or whatever time I chose, thankfully I did. And then the performance over all the back tests was just as good, if not better. So one may prefer to trade shorter term. Obviously, the drawdowns will be less, as long as the shorter term parameters make the same amount of money as the longer term ones. And being forced to go long term, or at least I thought I should go long term, when I did the back test, just as good as the shorter term trend, but probably better. So we didn't sacrifice anything. We were just too focused on what we'd always done and didn't have enough imagination to realize that longer term parameters and lookbacks are just as well. And then when I hear about JPB, endogenous market moves, of the 90% of them are endogenous. After a year or two, I'm like, hey, yeah, exactly. That's what the back test told me as well. And so that made me confirm my choice from a backtest statistical point of view and this philosophical point of view of JPB, which is underwritten by mathematical research, though.
Thanks, Jerry. Actually, Niels is here. I remember a podcast with Marty Bergen where he said that there was a time where they actually started stepping out to the medium to the long term as well. Do you remember the reasons that Marty did that, Niels?
Yeah, I think so. So I think the decision was to follow a more scientific and rules-based approach to how do we select parameters. And it's kind of going back to this thing about being evidence based and data driven. And so when you run your models using different time horizons, what you find is that they tend to gravitate towards the longer term. It doesn't mean that you can't have 1 year or 2 years where shorter term timeframes does better, of course. But in the long run, there's clear evidence that long-term trend following is significantly more successful. So again, I think that's really what you're referring to, is the fact that we chose to let our process become even more systematic, even down to how we select parameters, rather than having some kind of discretionary or committee decision-making process, which some firms still have. So, and that's fine. It's just not for us. And yeah, I think we're happy with that decision almost 20 years ago.
Thanks, Niels.
We did want to just give props to Rob Carver, because I really did enjoy he and Neil's podcast recently. And oh yeah, this is the one. This is the tweet, and I wanted to get Rich to comment on this. So Rob goes, the theoretical understates the importance of diversification and trading more markets. This is Rich's point. The actual improvement is big because correlation is a linear measure and doesn't account for the likely increase of outlier tail events. I love that. I mean, I was just like, and then I got this other quote from Rich. I'm not sure where I got it from, maybe Twitter, but it's just to follow up on that idea. Outliers increase in relative proportion with diversification, and the noise is suppressed through diversification. Genius. Love it. So that's just something I like to hear about, that I'm going to get rewarded for these 200 markets.
Yeah, Jerry, look, I posted a few, they're almost research pieces on diversification with trend following models versus diversification with convergent models. So what happens with diversification with the trend following models is we all know that diversification for any trading model is a method to reduce the degree of correlation in a portfolio. In other words, there are certain correlation benefits to be obtained by putting an ensemble of different return streams together, so that the offsets of their unique characteristics of each return stream, they cancel each other out. So it can sort of reduce the drawdown at the portfolio level. Now, we all know about that, but what we don't really know about, because Markowitz never proposed this, he always proposed that diversification was a means to produce better risk-adjusted returns, but the CAGR would never be improved. Now, that's because he was dealing with, most trading models, and most trading models are convergent in nature. Now, a very interesting thing happens with divergent models that have positive skew under diversification. So what happens is that with increased diversification of divergent models with positive skew, you actually get an improvement in CAGR of the diversified portfolio. So diversification produces two things with trend following models. It produces correlation benefits, which reduce the impact of adverse losses at the portfolio level, but it also amplifies the CAGR because of the positive skew, because that we are targeting these outliers, which are non-linear events, which need many negatively correlated return streams to offset the benefit of them.
And then Niels goes on to say something I totally agree with. I agree with Niels' one of his conclusions, which is, I just don't see this in the data, that trading all of these markets really matters a great deal. And, of course, I don't think he meant short-term data, because anything can happen then. Somebody trading 20 markets, if it's short bonds and short the yen, that's going to outperform my 200. But I agree, and I was thinking, like, why don't we see this show up as much? And my speculation was that this only works if you're hunting the outliers and trying to maximize them. But if you're turning all of the outliers into less of an outlier, you would expect that, well, all of the trades are in the 30 to 40 or 50 or 100 ATR range. You're not going to get the 500 ATRs in Tesla and Moderna and canola and rapeseed. they're all going to be like corn and beans around the 40, 50 level. And so you're not going to see a great deal of difference, because what happens is that every now and then silver doubles and gold sits there. Heating oil goes up, doubles or triples, and crude doesn't go up because there was a freeze in the harbor in New York and they couldn't get the heating oil in. And so I think that's why we don't see this in the CTA community so much, because the CTA community adds convergent elements, the vol management elements to the trend following.
I don't think enough studies have been done with positive skew models, and that's why people aren't seeing it. I mean, the logic is this: if you've got an outlier that is, 15 or 20 ATR, to offset the benefit of that outlier, you need 15 to 20 negatively correlated return streams, because remember, trend following models cut losses short. So the worst case scenario for each return stream is probably going to be a 1 ATR loss. So to offset that benefit, you need about 15 or 20 of them. And that's where these outliers drive the long-term wealth at the portfolio level. Correlation offsets or benefits is great for linear models like convergent models, as a way to smooth the equity curve. But with models with positive skew, you get these portfolio results that have these magnificent step-ups. You still get smooth components of them, but you get interdispersed with these magnificent step-ups, which are the impact of the outliers. Now, that impact of those step-ups is what is driving CAGR in the long term, that surpasses the level of wealth that can be developed by these convergent models. Because with these convergent models, they've got a negative skew. And what that does is you actually get an outlier in the reverse terms. In other words, you get an adverse outlier of maybe 10 ATR with negative skew. And therefore you need, 10 or 15 negatively correlated return streams to bring a favorable benefit to your portfolio. This creates this magnificent drag on compounding when you look at negative skew models versus the positive uplift created through positive skew divergent models.
Yeah, it just made me think of something I just think is, I hate to hear this kind of silly talk, which is that if you're down 50%, you have to make 100% of your money back. I don't think that's very enlightened. It happens all the time. All kinds of investments are down 50%. It's trying to give this impression that if you're down 50%, then boy, you're in big trouble. I mean, sure, but markets do that, and people go back to new highs. Hell, the S&P has done it many times. So, but it made me think about that little cliche, in the sense that, well, you know what? No matter what your drawdown is, if you're hunting outliers and letting the profits run, you'll get back to all-time highs. But if you're not, if you got these convergent methods, yeah, maybe for you that's going to be a lot harder.
Yeah, for convergent methods, it takes a lifetime to return to your high watermark after a big drawdown. But for divergent methods, it can be a jiffy before you're back to a new high watermark.
Hi guys.
Because of these outliers.
Richard, just two things actually. One, I do think we need to take into account that when you trade more markets, you're going to have a much smaller risk budget per market. So I don't know whether you take that into account when you say that you have to make up, so many negative trades if you miss one outlier. So I don't know about that. But the other thing I noticed was from the conversation with Rob, I think he concluded that to him, it's just luck or unluck for that matter. I don't know what you thought about that.
Yeah, the question of size, like, of course, under diversification, you reduce your risk budget per return stream. But the thing is that it's all relative, Neil. So the losses, therefore, are smaller. The outliers are smaller, but they're all still relative in proportion. So even though your risk budget declines, that asymmetry is still preserved in those return streams. That's the important thing. It's the asymmetry. So yes, it's not that, we've got to remember that the performance of our trend following models is as much determined by the outliers we catch as the losses that we incur. And when they're all relative, there's no problem.
Now, what is the optimum size of the market in terms of the number of markets that we trade? So, for instance, at the moment, I'm trading something just like 60 to 70 markets, all diversified across commodities, stocks, indices, forex. Would you think that instead of trading 6 to 70, what about trading more than 100? Because we have unlimited number of instruments today. The stocks universe is so large, so we can make this number a little bit more. So do you think there is a number that the number of outliers that we can catch actually would increase, or is there an optimum number of markets that you say that diversification benefits wouldn't go higher than 80 markets? So don't bother trying to diversify more than 80. I would love to hear your thoughts, guys. Thanks a lot.
So that's quite an easy one to answer. So if you are trading models that aren't capturing outliers, you are dependent on correlation. And what happens is, as you increase diversification of models that aren't capturing outliers, we certainly find that after about 25, 30 markets, 40 markets, the benefit of that diversification, which is the benefit of the correlation offsets, reduce. So the marginal benefit sort of goes quickly to zero as you increase the number of markets. But what happens as soon as you catch that outlier, it resets the whole exercise, because these outliers are these significant magnitude events. And you suddenly find that as you get more and more outliers, you effectively become unlimited in your ability to get diversification benefits from, and this is because the benefits are coming from the asymmetry of the outliers in a portfolio. In other words, you want multiple outliers occurring at many locations of your portfolio distribution of returns. So if you've got a 30-year track record of a portfolio, you want your outliers to be dispersed throughout that entire distribution, because every time you get an outlier, that step up in that equity curve magnifies compounding over the long term. And that step up takes a long time to whittle away with drawdown. So you want many of them. So the more you diversify, the more you get the benefits from the diversification of more outliers at different locations in that path-dependent return series. I hope that makes sense.
Yes, and I just wanted to, you said it perfectly, but I'm still going to say what I was going to say before you said it perfectly, which is there's the benefits of diversification for trading more markets, and there's the benefits of outliers. And it's two different things. And so in the non-trend following world, it's one thing. It's smoothness. In the trend following world, it's a bit of smoothness improvement, but it's an improvement in CAGR and profit. And I remember listening to Mark on TTU say one time with Niels something about 5 or 10 outliers per year. And I thought, no, it's 5 to 10%. It's 5 to 10%, not 5 to 10. Now, and of course that I think I would have a different answer, and this is all sort of common sense, but if I traded 1,000 markets and they were all stocks, or I traded 1,200 markets and 1,000 of them were stocks. So I wouldn't recommend that. As I said earlier, I kind of want to have similar commitments and weightings for the sectors, maybe somewhat similar. I do 30% stocks, 30% commodities, and 25% FX, and maybe I'm lost count. It's not going to add up to 115 or 20% interest rates, but something like that. I don't think there's a magic answer in the back test, at least. And here's another thing too. You do trade each one of them smaller. So if you're trading 200 markets, you at least are trading them half the size versus if you were trading 100 markets. But of course, if you're trading 200 markets, you can increase your overall risk versus 50 markets, let's say. So maybe if I would trade 5 units if I trade 50 markets, but I will trade maybe 6 units if I have trade 200 markets. So there is this bump up in taking advantage of the diversification and the smoothness, which we definitely are appreciative of, even though we're really just mostly concentrating on getting the outliers.
Richard, I think this touches on the conversation we are having, and is your tweet about needing more funds, more return streams like Mulvaney. Did you use actual funds, or was that a synthetic, revenue streams that you put together? And the reason why I'm asking the question is because I thought that exactly what Jerry just said. Casting a wide enough net would allow you to pick up all the outliers in the distribution and not just some. So diversifying the programs that do the same thing shouldn't really give you a step up in KGAR and all the things that you're talking about. So I just wanted to clarify whether your tweet was more of a plea for please can somebody do more of this, or just that you've identified 4 or 5 or n programs that actually stuck together achieve an even better result than the Mulvaney or the Jerry's of this world.
Yeah, that was a cheeky tweet, Bruno. And what I did there was, everyone knows Mulvaney, and they know that they've got a very volatile track record. So that's taken for given. So what I did was I took Mulvaney and I offset the results of Mulvaney by 12 months. In other words, used all of the performance data, but just offset it by 12 months. Now, the reason I did that was to offset the outliers in the distribution of Mulvaney. So then what I did was I said, all right, let's assume you invested 100% in Mulvaney, or you invested 5 by 20% in these Mulvaney-like programs. They all were using the Mulvaney track record, but they were just offset. What that was showing, it was demonstrating this offset of outliers. In other words, if you can get outliers throughout the distribution of your portfolio, distribution of returns, you get this magnificent result. And you saw that result with that example I posted. Now, it was a hypothetical example, but we find this with the TTU trend following index, where we start choosing an ensemble of 60 different trend following programs. Now, their outliers are not all co-located at the same location. Because of their different systems, their different programs, their different methods, their outliers, many of them are co-located, but many of them are interdispersed throughout the track record. And what that does is it significantly lifts the KGAR of the entire ensemble. So it was more a case of just demonstrating that diversification is not just a means to get correlation benefits, but it's also a means to get the benefits of the asymmetry and the benefits of the outliers in producing this long-term wealth.
And once again, just to restate the obvious, which is kind of my specialty, especially after Richard speaks, and that is, this is the surprising part to non-trend followers or mainstream trend followers today, which is that even though they're 90% correlated, 80% correlated in a sector, you have good representation, quote unquote, sometimes one of those things will be the JGB, or sometimes it'll be the yen. And then it'll go right back to being 90% correlated again. So another thing that really helps with the 200 markets is, I've been in situations where I traded 50 markets and the crude, heating oil, and unleaded all went down, and it just totally bummed me out. And I had a really nice drawdown, and it was just horrible. And I'm saying to myself, okay, I see that maybe crude, I've definitely had a couple of heating oil trades that made my year and they doubled in price, and the gas and the crude didn't do anything hardly. But this is really painful, and it's so 3 markets out of 50 now would be 3 markets out of 200. That's much easier to take when you do get in these situations where 90% of the time they're kind of correlated. Another benefit of trading a lot of markets. And just keep remembering that it's 5 to 10%, not 5 or 10 trades. We're going to be able to expect big outliers from any of these markets, all of these markets.
Bruno, your silence. I hope you understood what I was saying. Was that okay?
Yeah, no, it's perfect. It's perfect. I thought that you did something along those lines. I just wanted to get a clarification. Now, thanks very much. That was very clear. And for what it's worth, I agree with you. The point, if you want a point of contention, maybe it's just this idea that if the strategy, meaning hunting for outliers, is just allowing you to catch them all, why do you need more of the same in order to achieve a superior result? I mean, that the strategy, like one entry, one exit, one stop, should allow you to capitalize on all the moves. But obviously, I see why you're doing it, because much in the same way as you guys say this is the only way to do trend following, is also true that some nuances and variation at the margin, i.e., how thinly you parameterize your space, how many ATRs, where you set your stops, and things like that. So different application of the same rule or rules may result in different results. So may yield different results, and so you get this compounding and this step up benefit from having more than one program attempting to doing the same thing. So it makes perfect sense. It was good. Thank you.
Okay, we hit our 2-hour mark here, and I think that's a good stopping point. Thanks everybody for being here. Sorry I screwed it up. Hopefully we got the first recording, and hopefully Richard can work his magic. And
yeah, I've got the second part, so I'll be able to stitch them together, Jerry, so long as I can get the original recording.
Oh, perfect. Thanks so much for doing that.